Hey traders, welcome to Charts and Coffee. We got the Essentials room in the house. Great to see you all. And big good morning to my folks on YouTube and Twitter. All right, happy Thursday, gang. Hope everyone's doing well on what is already a fairly active morning. Some pre-market hot zones. We've got GDP, the weekly initial claims, ECB. So just as we have the FOMC monetary policy statement and then press conference, we have the same thing going on for the European Central Bank this morning. So clearly we're going to have some volatility in places like the euro. So 6E, whatever the 6E is doing, the opposite will happen to the US dollar. So remember, if you're trying to track what's happening in the dollar this morning, you're going to see the dollar is down because after that monetary policy statement, you see the euro is up. All right. So overall, euro has this week. This has been a big week for euro and dollar because this is the first time in quite some time that the euro, not since August, has a euro been in a neutral environment. Now, it's still very much in the bearish hemisphere, sitting below the 200 period exponential moving average. That means the US dollar was in an uptrend. Now it's in a sideways trend and it's above the 200. So not a significant shift in larger sentiment, but certainly a significant shift in if nothing else, trend. And overall intraday, the euro is up, but it's still below yesterday's close, which makes it not as big a deal. Until it can get above the Wednesday close, this is the 6E euro futures, probably not that big a deal for those of you watching the dollar as well. Anytime we have monetary policy, and I'd say the two biggest central banks for traders to keep an eye on, for those of you that do watch this sort of macro hot zone, is going to be the Bank of Canada and the European Central Bank. Right now, interestingly enough, there's another set of symbols we need to watch. This would be the treasuries, 10-year, 30-year, ZN, ZB futures mostly. The move higher, much like the euro, this indicates lower yields. Look at when it triggered. So if you're wondering, when did this move? Well, this did move with GDP. This did move in the aftermath of the ECB. So you might say, Rog, which one's moving it? Look at what time the candle was made and then corresponding hot zones. This would likely be the GDP. And this will be probably the first month where we have started to consistently see that good data is more bullish. Now remember, in the previous year, good data was a reason for the Federal Reserve to stay on their hawkish monetary path, meaning favoring higher rates. This is probably the first month where we're actually seeing positive data. This was a higher than expected GDP by 0.6, I believe, where good data actually is now indicating bullish response in the indices. That's a shift. We're also seeing lower yields. And this is going to be a little bit more along the normal good news is good, bad news is bad type reaction. We are above the previous session close in bonds. We are seeing the move higher. We are seeing lower yields in the aftermath of the GDP. Now, you might say, what about initial claims? Those came in pretty much flat. What we expected is what we got. Now, I know there are 4-week moving averages or quarter by quarter, month over month, year over year type moving averages. But for the most part, those are secondary considerations. The primary consideration is what was discounted, what was expected, and what did we get? And so initial claims were pretty flat. GDP was better than expected. And that is where we sit. Now, again, makes sense to look at the last few releases to see the trend in the data, but the initial response is simply going to be against the headline number. All right, so that is what we have to kick off the morning. And again, we can see the response in equities. Now, equities had a very weak, take a peek here. Even though we're up when you look at a 5-minute chart, for example, you can see we're up since about 3:30 this morning. That would be really more around the European Open, about 25 minutes after. We are still well below the previous session close. So while it's quote unquote up intraday, the overall sentiment is still going to be we're below yesterday's close. Here's the NASDAQ. Here's the S&P. So once again, there's two ways to look at this. What's this morning's response and where are we in relation to yesterday's close? And that yesterday's close measuring stick, the only place that we seem to be creeping just a bit above it, or at least testing it at the moment, would be the Russell small cap, which frankly, the Russell could care less about what the ECB is saying or doing. These are domestic small caps. Even yields, while lower yields, all stocks are going to like generally. The Russell can and does do its own thing. We'll keep an eye on regional banks this morning. All right, gang. So as always, best part of our show is your question. So let's go ahead and get into that. All right. First up, Jim, good morning. If the market decides to start buying in a day like this of likely more selling, what do you look at to manage a possible reversal? If the market decides, I don't know, but I don't quite follow the first part of your question, Jim, but let me answer the question that you have here. What do you look for to manage a possible reversal? So first of all, reversal on what time frame, right? And reversal being the sort of general umbrella. But Jim, if I have a downtrend, a reversal is not going to happen quickly. If I have an uptrend, likely a reversal is not going to happen quickly. Most transitions in the trend go from up to chop to either continuation, or say up to chop to down, or down to chop to continuation, right? Or down to chop to up, right? So there's going to be, if you notice, there's one thing with all those shifts, there's going to be a time of chop. So I look for the chop. Next up, what delta am I using on my naked long options? So I know it sounds so scary, naked long options. It almost sounds PG-13, right? So all that means is when I buy a call, I don't have to own the shares. I don't have to sell an option. So I'm just buying a call, and the absolute risk on the call is whatever I paid for it. All right. So it's not really naked. Some platforms will define it as such, but I think that insinuates a certain risk associated, which really isn't anything more than if I pay $1 for a long call, I risk $1 plus commission and fees, right? Obviously, there are different ramifications for selling premium than buying, but buying's pretty straightforward. So that's the first part of it, Munir. The second part of it is I don't look at Greeks at all. Never. Don't like them, don't need them, don't use them. Nothing wrong with them. I will say there's not a darn thing wrong with liking Greeks. But here's the thing that I don't like about the reliance on Greeks when we're trading. All of us here are doing what? We're using different indicators, probably price, volume. If you're in the sector secrets mastery, using volatility. So there are four factors that move a market: price, the volume at that price. And don't notice I didn't say the volume at that time of day or the volume on that day of the week. Volume, the volume at that price, the time of day, and the volatility. Those are the four factors. Most of us are making decisions based on one, maybe two or more of those factors. So that means I'm looking at the underlying chart. For example, let's go to, I think there's a question here on Google. I think First had a question on Google. All right, so let's go to Google to answer this question. All right, so here we go. So if I'm going to make a decision on Google, I've got to make two decisions. One, which time frame am I going to trade? And two, which direction am I going to trade it in? Now, all of our indicators are going to tell us to varying degrees what those two answers should be. Which time frame, what direction? So those are the two I would consider primary decisions that would have to precede every trade. Once I've chosen my time frame, I'm looking at price, I'm looking at volume, I'm looking at time, I'm looking at volatility. Not once did I say, well, what's the delta of the option that I'm buying, right? Or the theta or any of those things. If price, time, volume, volatility are getting me in, those are the things that are going to get me out, right? And the more I distance myself from basically the support and resistance on a chart, right? The more I'm distancing myself from the reasons that the price chart, the underlying of Google, not the call on Google, not the put on Google, but the underlying reason that Google's going to either follow through for me or not follow through for me is on the price chart. So I try not to deviate too far from decisions based on the thing that I think all of us are probably using. And as long as I get trend right, and as long as I give myself enough time to let the trade work, I'm never going to really lack for needing to know what the theta or the delta was. So that's my approach. But let me add two more things to that. One, don't pay for more time than you need. I don't need an option with 30 days to expiration if I'm day trading. Okay, don't buy for less time than you need. So if I'm looking at a daily time frame, give that daily time frame enough time to move. So, might be 14 days, 21 days, 30 days to expiration. So be realistic about the time to expiration. I think those are two really important aspects, two parts of it. Now, the second thing, give yourself enough time and don't pay for too much time. That's one thing. The second is I go with at the money. I do not go with out of the money calls. I don't believe we need to go deep in the money either. So I prefer at the money strikes. All right. Okay. So thank you for that. And then looking at Google, I'm going to leave this thing alone until I get some clarity. My typical guideline is standard. My typical guideline is after earnings, especially a big gap like this, we have a Grand Canyon of a gap on Google, is give it 1 to 2 sessions to figure out what it wants to do. Because after a move like this, some traders are thinking Google's going to continue to move lower. Some traders might think this is a blue light special. I don't know which it is yet. So I will wait. This could be a minor low, and today could be the confirmation of that price pattern. So I'm going to wait till I have a setup. It's at the daily point of control, which is fantastic, in that if now I can get a minor low, I'm with you. I'd rather be focusing on Google to the long side. I would much rather be focusing on Google to the long side. I just need a reason to say, here's my entry, because my entry is where I determine my risk, right? Without understanding what the trigger for the entry is, there's no way to say where my point of validity is. So really, that's all I need at the moment. All right, next up is okay. iPod. The S&P went right to a 10% correction, now bouncing on GDP. I believe this is a key reference to rally if we hold. Do I agree? I need a setup. So a 10% correction is a completely random thing to me. Is 9 not enough and is 11 too much, right? So 10 is, psychologically speaking, you're spot on. It's good to know what, psychologically speaking, folks are looking at 10%, 20%. We tend to glom to those big round numbers. Bouncing on the GDP, right? That's going to be a catalyst, macroeconomic catalyst. And interestingly enough, good news is good. We haven't seen that consistently in many, many, many months. At the end of the day, if we're going to rally, let's go back to the 4 factors: iPod, price, volume, volatility, time. If the timing is a GDP catalyst, great. That's one thing. If the volume is, let's say we've got a point of control of some sort, great. That's another thing. Volatility, I'd like to see some volatility support. So if I look at something like the S&P, let's go on over there. There we go. Okay. So if I'm looking at support, I don't have support that's buyable yet. iPod Touch, not on a daily, right? Take a look at the structure of the trend. I've got a red trend. So I could look for individual stocks. I could look for individual sectors. I could even just instead take a look at a non-downtrending index. And I would say in that regard, it's less about whether or not we could rally, and which we could, right? We could. But it's more about which index is more poised to potentially rally, having not still being stuck in a downtrend. Russell's in a downtrend. I believe the Dow's still in a downtrend. S&P is in a downtrend. So I'll look for a rally more in the NASDAQ or I might look for individual stocks or individual sectors. So until I get a setup, don't know, my friend. All right, next up, can I look at the tech for QQQ, Amazon, and Google? Let's go to just QQQ here, D. Stick with that one. Let's go broadly on that. So if I'm looking at a swing, that would, for me, denote overnight exposure. And if I'm trading futures, I've got access to this market before the bell, right? So if I'm looking at NASDAQ, remember, it's a 23-hour market. If I'm looking at QQQ, that's 9:30 to 4. Ultimately, what I'm seeing is we're bouncing off the 200. That's a big deal. I'd like to see us above the previous session close. That would be nice. And if I'm going to put on a short-term swing, where the time frame that I would use for that is going to be the 60-minute time frame, then I would focus on waiting for the 60-minute on the NASDAQ to go yellow. So the only place that I can buy, and it won't be a swing, because the 5-minute is not going to map to overnight exposure the way a 60-minute or a daily would. We'll probably look for some buy the dips, hourly price movement range, maybe the Pingala. We'll look for some of those this morning. So right now, it's still a very short-term approach. And remember, gang, we're still in that part of earnings where we're getting all those tech releases. And if you haven't noticed, the weighting of these names is unique. Tech is, of course, going to move the NASDAQ, but it's going to move the S&P and to a certain degree the Dow. Tech is unique in that, so for example, financials affect the Dow and the S&P. If you take a look at healthcare affects the Dow and the S&P. If you take a look at transports, industrials, that's pretty much the Dow. You take a look at energies, it's pretty much the Dow. But when you take a look at tech, say XLK, XLC, XLY. What are those names? What are those ETFs? Apple, Microsoft, Meta, Google, Amazon, Tesla. You want to throw the 7th one in there. That's the Magnificent Seven. NVIDIA, your number 2 weighted, 1 weighted in the SMH, or semiconductors. Those have a unique impact across the indices because tech is so heavily weighted across all 3 of the major averages, Dow, Nas, S&P, but not equally, right? The place where financials are going to have more of a burden on the indices is going to be the Dow and the S&P. The reason I mentioned the financials is that's the number 1 weighted sector in the Dow, the number 2 in the S&P. So we can either, and we were talking about this yesterday during the session, we can either go right at where the volatility is, which is what most traders tend to do, or we can trade around it. So if y'all recall when NVIDIA had that crazy morning on the news, we can either trade NVIDIA, or we can say, where does NVIDIA not really impact the broader averages? Mostly the Dow and the Russell. Russell doesn't give a rip, right? So we can trade around these things. We can go right to them. I think trading around them tends to be usually the better choice. So that's another thing that we can think about when we have these big time events or hot zones or unforeseen news, the way NVIDIA was the other week. Is natty gas coming up to a seasonal buy period? Larry, it ignored the last one. So I would have to say I am not going to rely on natty and some sort of seasonal move, because we have typically the seasonal move preceding summer and a seasonal move preceding winter. And since it ignored really the seasonal tendency pretty much all of 2023, we've got to stick to structure. So I would not look to natty to say, hey, let's see natty act like natty. It just hasn't been at all. In fact, October really hasn't acted like October. If we look at the tendency, the rhythm of what's happening in the broader averages. All right. So that is a wrap, gang. As always, thank you so much for being here for Charts and Coffee. I'll see you tomorrow, same time, same station. Have a great morning, gang. I'll talk with you soon. Be good to each other.